About your note here, you talk about big tech earnings defying fears of the worst case scenario. Is that enough to give you confidence that these companies can maintain earnings growth moving forward?
Yes, absolutely. I mean, it was a big week last week with most of the Mag 7 names reporting, and I think overall the AI story remains intact, which is really important for the market, especially in case of uncertainty. We hear when we look at capex spending, it's high. Some companies even raised that bar even higher, which gives us a lot of confidence here that the Mag 7 can further drive the market here. And what we also looked at, especially with the Mag 7 names, with some of them is ad spending. How is ad spending developing here, right? Because that could be the first point where businesses are struggling, that they're pulling back ads, which we didn't see at all. When we look at Meta, ad spending come in above expectations, defying all odds, which is a good sign going forward, and especially a good sign for the tech and for the Mag 7 earnings.
So Lisa, what is your biggest concern for the big tech names going forward for the year?
Obviously, it was decelerating in the AI spend, right? We heard a little bit earlier in the year, we heard something from China, DeepSeek, right, where the market reacted very negatively to that. I think that is behind us because when the general new development of AI and what drives us forward is happening here with the Mag 7 tech names, right? And if you build something, if you build the future of AI and innovation on the green space, you need a lot of money for that. And that is continuing to drive the markets here. So I would be not so concerned about that. And we heard with the last earnings season, capex spending remains intact. The overall demand remains intact, which is very positive here.
You say, Tim, for investors, there are three potential scenarios to think through in the months ahead. Walk us through, Tim, to start, what those scenarios are exactly.
Well, Josh, it's great to see you. And right now, we think it is incredibly important for investors to prepare their portfolios for maximum flexibility. Nobody knows the end game when it comes to tariffs. I'd venture to say not even the president himself knows the end outcome. And this could go many different ways. You know, on the bullish side of the spectrum, we could see very significant deals struck with all major trading partners, which could very easily push the S&P 500 up into 64, 6,500 range. You could see legal challenges to these tariffs be successful, or you could see the president start to walk back some of what he's laid out thus far this year. That's the bull case. Very good odds of one of those three playing out. And then on the bearish side, which is almost equally as important to be paying attention here, you could see deals struck with just some of the minor trading partners. There's a lot of hair on deals when we look at things like China or the EU. If that happens and those tariffs stay on for a long time, a recession would become our base case, in which case you'd see valuations derate meaningfully. We could easily see the S&P going back to that 41, 4,200 range. So right now, a lot of question marks. Need to prepare that portfolio for maximum flexibility.
So how do you go about doing that? I mean, because these, even though there might be some bleed over from some of these cases to one another, right? There might be some from column A, some from column B, but it seems as though there might be quite different outcomes in markets depending on what happens here. So how do you prepare your portfolio for any one of them to happen?
Yeah, I think there's a couple different options here. One would be looking at specific names in the market that are going to be more insulated. When we look at names like Microsoft, where they sell software, right? They're not going to be as impacted by the tariffs. They're also in the midst of this AI trade, which we don't think anything is slowing that down. You heard a lot of the spending announcements on recent earnings calls from the Metas, Amazons of the world. That trend is going to continue. So finding gems or diamonds in the rough like that is one way. We're also seeing a lot of interest from investors moving into strategies that help cover you on the way up and the way down. One idea that has been very popular this year, managed floor ETFs like SFLR, where you're targeting a 10% floor against losses on the downside. And then if the market goes up, you're participating in 70 to 80% of the gains. So we see both of those methods, really finding those stocks that are going to be more insulated, and then also hedging with options-based strategies like SFLR as really a good way to manage around and prepare for a wide range of outcomes.